Introduction to Funds Transfer Pricing, FTP. What is Funds Transfer Pricing, FTP? Funds Transfer Pricing, FTP, is a mechanism used by financial institutions to assign profits and costs to different business units in order to accurately evaluate their performance. Essentially, FTP is an internal pricing framework used within banks to calculate the cost of funds and allocate them to the various business lines. Why is FTP important? FTP is crucial because it helps financial institutions better understand the profitability of their products and services. By assigning costs and revenues to specific business units, banks can accurately assess the contribution of each unit to the overall profitability of the organization. This enables effective decision-making and ensures that the bank's resources are allocated optimally. How does FTP work? FTP works by assigning a cost of funds rate to each business unit based on the funding they utilize. This rate represents the cost that the bank incurs to obtain funds for lending or investment purposes. The business units then transfer this cost to their respective products or services to determine their profitability. Components of FTP. There are several key components of FTP. 1. Cost of funds rate. The cost of funds rate is a key element of FTP. It represents the interest rate at which the bank can obtain funds. This rate is influenced by factors such as market interest rates, credit risk, and the bank's own cost structure. 2. Assets and liabilities. To accurately allocate costs, FTP requires a clear distinction between assets and liabilities. Banks need to identify which assets generate the funding requirements and which liabilities provide the funding. 3. Liquidity premium. In times of market stress or economic uncertainty, banks need to incorporate a liquidity premium into their FTP calculations. This premium reflects the additional cost associated with accessing funding during times of liquidity constraints. 4. Time horizon. FTP calculations are typically carried out over a specific time horizon, such as a month or a quarter. This allows for regular assessment of business unit performance. Benefits of FTP. Implementing FTP within financial institutions offers several benefits. 1. Improved decision-making. FTP provides accurate cost and revenue allocations, enabling banks to make better informed decisions regarding product pricing, resource allocation, and risk management. 2. Performance evaluation. By accurately assigning costs and revenues to business units, FTP facilitates fair performance evaluation and incentivizes efficient resource utilization. 3. Risk management. FTP helps banks assess the profitability of different products and services in relation to the risks associated with them. This allows for better risk management and mitigation. 4. Regulatory compliance. Many regulatory frameworks require financial institutions to have sound FTP practices in place. Implementing FTP ensures compliance with these requirements. In conclusion, funds transfer pricing, FTP, is an essential tool for financial institutions to accurately allocate costs and revenues to different business units. By implementing FTP, banks can make informed decisions, evaluate performance, manage risks, and ensure regulatory compliance. It's a valuable framework that drives profitability and enhances overall organizational efficiency. Want to learn more? Claire Trithel on LinkedIn.